Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we got another video for you, and I'm going to be talking about my investment criteria. Look, in a lot of videos, I always talk about this stock meets my investment criteria, that stock meets my investment criteria, or this stock doesn't really match my investment criteria. And I want to cover off what that actually is. I've had a few messages from some of you guys that, Curtis, what actually is your investment criteria? What is this investment criteria that you speak of? And, essentially an investment criteria is just a set of metrics, it's just a set of factors or characteristics that you expect your stock to hold or to have. And obviously, if it meets that, then obviously it becomes an investable opportunity. If it doesn't meet that, then it potentially isn't. But I think the key thing is about having an investment criteria as a guideline, not necessarily a hard and fast rule. And then obviously on a case by case basis, you can flex where it's important. So I'm going to be talking to you about that today. And my goal for today is for you guys to leave a little bit more confident in selecting your own stocks and creating your own criteria so that you can, find stocks that you feel comfortable investing in. So if you want to be more comfortable picking and selecting your own stocks, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear and simple and transparent manner. But first, let's talk about investment criteria. So here you can see my world of stocks, and they all come in a lot of shapes and sizes. Some are doing well, some aren't doing well. But one thing they all have in common is at the time I purchased them, they met my investment criteria. Now, funny enough, what can happen is that things change. Things change over time. A lot of them had good PEG ratios at the time I purchased them. Their PEG ratios right now aren't so good. A lot of them had good earnings forecasts at the time I purchased them. Their earnings forecast at the moment is better, or sometimes it's worse. A lot of them might not have had that much debt now that their debt has gone up, or say in the case of Vodafone, it might be going down. So, investment criteria can change, and the stocks, once you buy them, don't be surprised that in a few months' time it doesn't fully match the criteria it was at the time you bought. The key is at the time you're buying, at the time you're adding to your portfolio, they meet a set of benchmark criteria that you deem important for yourself. So what I'm going to do first is flick over back to this spreadsheet. This is the spreadsheet that I leave in the link of a lot of my video description when I'm giving you guys some tools and tips, etc. But this is my own personal one anyway. And I always say that when I'm filtering stocks, this is sort of the criteria that I look at. Now, before I get into this, I would say there's three ways you can find or discover a stock. There's number one, which is the way I'm doing now, where you've got a list of stocks that's available on a platform. You know that there's a limited availability of stocks on the platform, such as free trade at the moment. So there is no point trying to look at the whole world of opportunities of stocks, seeing as there's like 85,000 stocks in the world. So seeing as free trade only have 300 or 350, you might as well just investigate each one of those on a case by case basis and see if it meets your criteria. That's way one to potentially do it. Way number two to potentially do it is to actually start broader. So to say, this is my criteria and these are the things that matter to me, and then find stocks that match or meet that criteria, and then go after the platform that potentially holds that stock. There are some investors that have multiple platforms just to have one or two stocks that meet their criteria. Me personally, I don't think I'm going to have like 10 platforms for 10 different stocks, but what I will probably do is a bit of a hybrid. So I might have some on free trade, some on Robinhood, and sort of call it a day, maybe a couple on Evervest and call it a day. But what I won't be doing is, if there's one beautiful stock that meets everything I really want, but it's only on HongKongTrade.com, and I have to go to there and sign up for £30 a month just to get that stock. Nah, that's not me. I'm not really on that, to be honest. So I think it just depends on your appetite and how far and wide you're willing to scour the earth. But I think there's so many investable opportunities that you don't really need to bend your back to do something like that. But that is another approach you can take. The third approach is just taking recommendations. So seeing what other people are picking, seeing what analysts might say, going on those analyst websites and they saying that this is a good buy, this is a bad buy, this is a strong sell, this is a good buy, etc. And then if it says it's a good buy, just be like, all right, cool. If an analyst says it, I'm gonna buy it. That's the way I like the least, if it's my personal take, just because I don't mind analyst recommendations, but I think analyst recommendations needs to be one factor of an entire picture, so to speak. It needs to be one part of the whole pie. I don't think it needs to be the pie itself. I don't think it should ever be the pie itself. So currently I've been taking option A just because of the way that free trade has been launching and adding new stocks. But I think, the day that Robinhood lands with 5,000 stocks, I'm probably going to go with a bit of option B and try and find the stocks that I like, and then see if Robinhood has them. And if they have them, then I'll go and buy them. If they don't have them, then either I'll try again, or I might have to do a modified version of option A for Robinhood's approach. And then in any of those two scenarios, I might just take a bit of the analyst view just to kind of see what other people are saying. But if we're taking option A to start off with, the four things that are really, really key to me, and they do vary, and there is a such thing as weighting, and I could probably put a weighting on it as what's more important to others, but I kind of take that on a case-by-case basis. But the first thing is being undervalued. I like to buy established companies that are undervalued. That's my number one criteria. Now, in this spreadsheet, I think if I check the conditional formatting, the undervalued green bit starts at about 50%. So in fact, yeah, 50%. So it starts getting green for 50% from me. So originally, when I created the spreadsheet, I considered if it's 50% undervalued or more, that is what is green to me. And obviously, the higher, the more green it could potentially be for me. But I think as I've started investing and as I've gone through the course of the year, I've actually relaxed this a little bit. And I think, to be honest, 35%, that's actually good enough for me in terms of how undervalued a stock can be. Sometimes, as we saw in yesterday's video, if it's too undervalued, such as Hammerson, actually it's not a buying opportunity. It's potentially a very, very risky stock. So with those scenarios, you have to take it with a bit of a pinch of salt because of the method they use to try and test the value. It is a bit of a forecast. So it is a good starting point, but obviously it's not the be all end all. But I will say 30% upwards undervalued for me is definitely, I would say, number one in terms of my criteria. Number two in the criteria, and this is just because of the order it appears in Simply Wall Street, it's not number two in terms of my priority, but just number two in terms of the criteria, is the PEG ratio. Now, as we know from the fundamental series, a PEG ratio of 1 is good. Anything below 1 is fantastic. That's technically a strong buy. Anything above 1 and the higher you get is, the more you should sell or not buy effectively. Now, I think there's not a lot of companies from what I've seen that's 1 and below, except a lot of financial services companies and a few mining companies, etc. But there are some, but there are very few and far between. So I've been willing to relax this a little bit and say anything from 1.5 downwards, I'll be willing to take a punt on if other things obviously line up. So PEG ratio is really important to me, more so than PE ratio, because PE ratio, as you guys know, is price to earnings. So price in relation to the company's earnings. PEG ratio is price earnings to growth. So it's also in relation to the company's growth forecast. And it allows you to benchmark companies against each other that are in different sectors, whereas PE only allows you to benchmark companies within the same sector. So with a PE ratio, you can benchmark Sainsbury's and Tesco, but with a PEG ratio, you can benchmark Sainsbury's and Centamin, just because of the way it's calculated. So that's the way I like to use PEG ratio as my second element of criteria. My third criteria is their future performance. I want the company to do well. I'm really, really passionate about the company doing well. I don't want to see the company making a loss. I don't want to see a company making a performance that I don't think is good enough for either its sector against its peers, or just for what the company, should really be aiming for and should be trying to achieve. So with the performance, I think I've set it to about 30% again upwards. But but it really, really depends on the company and the sector. If it's a massive established company, say the likes of an Aviva or Legal in General, I will go down. It can be 5, 6, 7%, just because when you are, a cash cow, when you are a company that big, you generally aren't going to grow at such an exponential rate as you would if you're, say, fresh from an IPO or a tech startup, etc., etc. So again, it's on a case by case basis. You have to kind of look at it, but I would say on average, I would like to see about 30% upwards. But if it's a really big established company, I'm willing to take that all the way down to about 10%, maybe even less, depending on the company and also depending on the other factors. The fourth criteria is dividends. Now, I've never purported to be a dividend investor. I've always been a value investor. However, a lot of value companies, because they are established companies, they do pay a dividend, and I would like the ones that pay at least a 5% dividend. So from a dividend standpoint, 5% is my criteria. It's the benchmark that I would like to go for. Now, I've got loads of stocks, which you'll see in my portfolio, that don't pay 5% dividend. They pay 3%, 1%, 2%, 4%. Again, I take it on a case by case basis. If a stock is going to pay me a 4% dividend, but the future growth is really good, the PEG is really good, and the potential share price growth is quite undervalued, I'll take a 4% dividend, because that's not the primary metric in that scenario. However, if some of the other metrics are okay, but the dividend is really good, then I might take it for the dividend, because I know that might offset any potential losses within the undervalued standpoint if it doesn't perform to be so well. So this is where you kind of got to play and use a little bit of your intuition. And one thing, not to get really philosophical, every single one of you guys that are watching this video is very, very unique. And I mean that, from the bottom of my heart. And what I mean by that, to be honest, is that we all come into life with different worldviews, different perspectives, different takes, different experiences. And so what works for one person is never guaranteed to work for another person. And, you guys might have insider knowledge on a specific sector or industry just because maybe you've got a family member that works in it. And that's going to be crucial in helping you guys make investment or stock market decisions. I might have, specific knowledge on a sector because I've worked in it, or I've got a family member that works in it. And then that might change my perspective. So try and use all of the things to, that's your surroundings, to your advantage when trying to select stocks and, knowing what to potentially invest in, because, that's where everyone is different, and that's where it can be really, really powerful for you. And I only say that just because one of the reasons why I've got a lot of banking stocks is just because I understand how banks work from working in a bank, etc. And so because of that, it made me feel a little bit more comfortable with taking a bit more of a risk with certain banks, etc. if I know what they're trying to plan to do and how that could potentially be profitable for them in the future. So use, your worldview and use your stuff around you. Now, there is a few other factors that I do take care in selecting a stock, but I call those my secondary factors. So these are my primary factors for me to even look at the stock. If it doesn't meet the primary factors, as in it's within, let's say a 20% threshold either side on any one of these metrics, if it doesn't meet that, then I'm not even going to bother investigating it for the secondary factors. But if it does meet that criteria, then I will go and look into the secondary factors. If it meets 3 or 4, I will take it to meet the secondary factors. If it meets 2 or 4, it depends which 2. If the 2 that is very undervalued and it's got a great PEG ratio, but the future performance is not as good as I want it to be, it doesn't pay a dividend, I might do it. However, if the PEG ratio is terrible and it's not undervalued, but the dividend is really high and the future performance is really high, then I might not do it. I mean, it all depends. Again, it depends on the stock. It will depend on the industry. But this is where there's no hard and fast rule. I will take it on a case-by-case basis. But I'll use this as a broad level to just kind of minimize it down. And then obviously I will try and work it out. But let's say, I found what I'm looking for. Then I will start to look at my sort of secondary criteria. And I'm going to go and use the brand new version of Simply Wall Street here. And I'm going to do this for the first time with you guys and try and do a screener and see if I can find stocks that kind of meet the criteria that I'm looking at. So once I click on advanced filters, these are all of the things you can kind of filter the universe of stocks on to find the ones that are applicable to you. So this is kind of option B. Now we're currently looking at where, you just have a world of stocks to your disposal and you want to kind of find the criteria that matches you. Now, market cap, I generally don't care about the market cap of a company. It could be small or large. It just depends on the company itself. Small ones have a higher growth potential. Large ones might be more stable, especially in a negative, depressed, bearish market. It all depends. I don't really care about share price. Now, ideally, if the share price is $1,000, it's got to be an Amazon or a Google. It's got to be something that I'm really, interested in. Other than that, I probably won't invest anyway, but I won't use that. I won't whittle it down based off share price. But I have met some of you guys that do have a share price metric and want to keep it within a share price because it kind of helps you, buy more shares, acquire more shares, and, feel like you're actually getting more for your money. And, that's perfectly fine. You can obviously do that. The volatility metric, I don't use this. Now, I know some of you guys have questioned me, do you check the beta volatility metric and check how volatile your stocks are? I don't. When I look at my current portfolio, I don't know if you can actually see it here. I'm going to come out of this. My current portfolio at the moment is not that volatile, I think, when you benchmark it against the market. So yeah, here you can see the volatility metric. This is where Infinite Investors' portfolio is sitting at currently. Obviously, the lower it is, the less volatile. The higher it is, the more volatile. Now, I have got some stocks that are towards the volatile end, but generally they're all yellow or green, and a lot of them are very green. And so on average, my portfolio is sitting here. So my portfolio isn't that volatile anyway. So to be honest, I don't look at it as a primary thing. However, it can be something to look at. But when I look at it, First Solar has been one of my best performing stocks. CYBG probably been one of my worst performing stocks, to be honest. Snap has definitely been one of the better performing stocks, but I didn't get it at the right time. CVX has been okay, but that's considered the market average. All of my other stocks are below market average, so I'm more than fine with not having looking at the beta volatility. If I get a few more volatile stocks, then so be it. But let's go back to the screen now. I don't care about market cap. I don't care about share price. I don't care about beta or volatility. So I'm just going to leave that. But I do care about value. Value is important to me. So I want my stocks ideally to be at least 30% undervalued. So I drag this to 30%. So it's going to be 30% and higher undervalued. That's going to be an important factor to me. I don't really care about PE ratio, but I do care about price based on expected growth. And so in this scenario, I want it to be 1.2, but you can only go 1 or 2. So in this scenario, I'm only going to go 2 because then that will capture anything that's like 1.2, 1.3, 1.4, 1.5, etc. So I will go for 2. But, ideally it should be 1 and below, but I will go for 2 just because from prior experience, I've seen that it's quite difficult to find a lot of good stocks that with a low PEG ratio that isn't in just certain sectors. So I'm going to go with 2 for that. Price to book, I'm not too worried about that unless it's a company that's got a lot of assets such as house building companies, but that's when you've got a specific thing in mind and you want to look at it. Now, in terms of future growth estimates that we just spoke about, you can look at 1 year or you could look at 3 years. I'm going to say 1 year, and in the 1 year, I want it to grow at least 10% is what I'm going to say. Just in case they're a big organization, so it has to be a minimum of 10%. But if it's 3 years, I want you to grow at least 35%. So that's 10% on year compounded, probably a bit higher. So, I'd say 30% just to make it easier. So if it's 3 years growth, I expect it to be 30. If it's 1 year's growth, I expect it to be 10%. We're just going to start with that and see if that spits out anything. I don't go for past performance. I'm looking forward, and past performance is powerful, very, very powerful, particularly when looking at ETFs. I love looking at past performance when looking at ETFs because I think ETFs generally, they follow a similar trend. I mean, they can go up and down like anything else, to be honest. But I think looking at past performance for ETF for me is a little bit more favorable than looking at past performance for all individual stocks. So, in just terms of whittling it down, I'm gonna skip past performance, but I will go to debt and equity ratio. So this is what I would say is one of the secondary factors. I don't like companies with a lot of debt, so I'm gonna bring down the percentage. This is the percentage of debt to your equity, I believe. So we'll see if I'm wrong. I might be wrong because it's the first time using this. So I'm going to say 40%, which basically means 60% equity to 40% debt. That's what I'm basically going to put. Now, they might have debt. Debt is not always a bad thing. It just depends on how the company manages it, and it's not going upwards. It's in a downwards trend as well. So ideally, you want no debt. Actually, you don't necessarily always want no debt. It all depends on the company, but I think if it has less debt, then it's going to be more safer. It's probably the better way to put it. Dividends, I'm going to say I want 5% dividend, a 5% yield. Only show companies with an upcoming dividend. That's interesting. I won't do that though. I won't do that. I won't cheat it. An insider buying ratio is interesting, but you know what? That is one of the things I look at, but it's not really the main thing. I will include ETFs and funds in this. Now done. Now what do you spit out? Updating results. 7. Only 7 companies found. Damn, I'm tired, boy. Only 7 companies found. So let's look at Noni B. What's Noni B? Noni B, Noni B is high growth potential, good value, engages in the retail of women's apparel and accessories of Australia. So let's look at it. Now the graph looks like it was going upwards over the years. It started to plateau in 2019. Potentially it's starting to trend down. That could be a bit of a worrying sign if I'm honest. The last year return has been minus 23.2%. That could be a little bit of a worrying sign. Again, it looks very, very undervalued, which, can be a good thing, can be a bad thing. It all depends. The PEG ratio is very low. That's very interesting. Future growth. That would depend. I have to look further into it. Based off 2 analysts, that's a cause for concern. I like it when I see like 10 analysts or more. If it's based off 2 analysts, that's just like 2 friends. Like that don't really mean that much to me. And then when I scroll down, past performance 74.3%, historical annual earnings growth. And then if we scroll down to the dividends bit, the debt is okay, it's covered. 9.16 is a very high dividend, which might be quite risky. So that's not something I'd probably invest in, if I'm honest. I would generally do more research on it, but to be honest, just at face value, it doesn't feel like something worthwhile investing. As in, not saved any of my things. That's really annoying. So let's go value, and we're gonna go 30%. We're gonna go PEG ratio. We're gonna go to 2 for. Let's just do one of the future growth. So I'm just going to do future growth 1 year earnings, and I'm going to go 10%. I'm not going to do the 3 year one. Let's just do that for now. And I'm going to leave the debt and equity, but I will add a dividend. And I'm going to say the dividend now, I'm going to put 3%. Let's see, because I've got 7 results, and that's just basically saying that I'm a bit tight. That's a bit mad, to be honest. Updating results, 379 companies found. That's a little bit better. And here we can see one of the stocks that was one of my stocks to watch, Bristol Myers Squibb, which I did a video on that. Here we can see British American Tobacco, Qualcomm, which we know is a good stock, AT&T, which is a 6-star dividend payer, Prudential. See, now we're seeing stocks. Now we're seeing stuff. We're seeing some stocks. So maybe I was a little bit tight before. But we're seeing some stocks. But this is where you can kind of obviously be a little bit more flexible with your criteria. So let's look at Vici Properties. It's an experiential real estate investment trust. It's a REIT that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations. Boom. Let's get a REIT and let's check it out. So when we go, obviously, it's a very undervalued with a solid track record and pays a dividend. See, the graph here is a little bit better, bit more volatile, ups and downs. It's had a dip here, which we can kind of see. The reason why would have been maybe to do the expansion, but I probably need to do a bit more digging about why it had such a big drop. Could have been just market conditions as well. 1 year return 0.37. Don't worry about 7-day returns, minor. It seems 63% undervalued. 0.7%, which is a little bit more realistic than the one we previously just saw. And then Barcelona 76.1. And then I'm scrolling down, scrolling down, scrolling down. Debt to equity. So it seems like low level outside assets. Debt is covered by short term assets. Debt is not well covered by operating cash flow. Properties leveled at 50% compared to net worth is higher, greater than 40%. So the debt isn't the worst, but it isn't the greatest. But a strong dividend yield of 5.94%. Now, in terms of the dividends, it's paying a high dividend. It's above the market. It's too early to tell whether the dividend is stable. So once you find the dividend that you want, I would look at the other dividend metrics, which I'm not going to cover in this video because I've already got videos on that. So go and check out the dividend video. I'll leave the link in the description. And it's too early to tell if the payments will start increasing. So it's quite obviously a new without that sort of track record. But potentially this is something that I might investigate a little bit further. And it doesn't make me feel as nervous as the Noni. Why is it not saving it? That is really, really bad. I should maybe have to save it. I don't know. But that's effectively how I might look for stocks and find stocks that don't meet, aren't in the free trade platform, and I just want to kind of look at stocks broadly and work out what it is that I might want to do. When I did the Evervest video, I also showed you an example of doing that in our old Simply Wall Street, and explained, how that would work. But I think effectively the key thing is, and I'm just going to go to one of my stocks, just to kind of use that as a benchmark, is, always have your, understand whatever it is your criteria is. So if, for example, let me just choose, I don't know, what's one of my stocks is here. I'm going to choose Barrett as an example. Barrett for me has been a very good performing stock. So we see that it says flawless balance sheet, good value, and pays a dividend is the snowflake description. We've got a graph that looks a lot more favorable. I bought Barrett, I think it was the 12th of December is when I first started buying Barrett. So that's about here at about £4.47, £4.68. And obviously it's trended upwards, gone a bit down, but still been trending upwards. So that's when I actually started buying Barrett. So obviously the performance for me has been pretty good. 1 year return 15.4%. Obviously recently it's not been so great, as we know, for the market conditions. 31.7% undervalued. So this is where it's just a little bit more realistic, I think, than the fall. Like when it goes like more than 50%, you kind of maybe have to be a bit cautious. Could be a fantastic opportunity, but it could be a bit dodgy. The PEG ratio is 2.2. It wasn't 2.2 at the time I bought it. I know that for a fact. I'll try and find out what it was at the time I bought it, but it was probably like 1.3, 1.2, and it's gone up. And that's probably because the share price has gone up. So now it's the expected earnings is now fallen, which then means the PEG ratio is gone higher. Hopefully that all makes sense. Future growth is 4%. Again, that's all. They're all levers in the same metric, so to speak, just from a different side. So I think it used to be a lot higher, and now it's gone down. But yeah, that's probably that. Past performance 19.4%. Again, a lot more realistic for an established company. We can see the debt to equity ratio is very high equity to very, very low debt. Able to meet its commitments. Barrett's developments, cash and other short-term assets cover its long-term commitments. Debt 4.4% compared to less than 40%. The level of debt compared to net worth has reduced over the past 5 years, 10.7% versus 4.4% today. Debt is well covered by operating cash flow. As you can see, interest payments of debt are well covered by earnings. So it's a beautiful company in terms of the balance sheet and in terms of its debt to equity ratio. And expected dividend yield for the year will be 7.76%. So Barrett, for me, has a lot of things going for it, and that's the reason why I would potentially invest in an organization like this. Now, obviously, it hasn't been paying the dividend for 10 years. it's only been paying it for the last 6 years, so they haven't seen it increase for the last. But if you're a dividend investor, you might want to see all 4 ticks, so that could be understandable. But because dividends is my main priority, I don't have to see all 4 ticks in that scenario, because I might not have it for the next 2, 3, 4, 10, 20 years, etc. I might flip it by that point. But yeah, that's my investment criteria. I look at the undervalued status, I look at the PEG ratio, I look at the future performance, and then I also look at the dividends. And then obviously there's other factors such as the debt, that I've also mentioned as well, such as the insider trading volume as well. And those things become, which you can see here, and some even little things like the institution, but that's not one of the criteria I really would look at in order to make the purchase. It might just be some tertiary information that I kind of want to know about the company. I will say as well, never base all your decisions solely off quantitative metrics. You also have to look at the qualitative side of an organization. And what I mean by that is go read articles, understand what products they're selling, their service, their business model, understand how many customers, if like, have they been growing, understand if there's any lawsuits, any legal issues, what competitors are in the market. Just generally, if you were running the business, all of the things you'd want to know running the business, look at it like that when you're investing in the business as well. So these are just the straight quantitative metrics, and I don't believe anyone can just be 100% brilliant investor purely looking off this quantitative stuff. Otherwise, it'd be too easy. I could just do this all day long, and just never leave my house. But I think you should always look at those other factors. What have they acquired? What are they selling off? Look at the situation with Vodafone as an example, selling off TowerCo. Those factors are really, really important as well, because that obviously helps move the share price and move some of these metrics in different ways, because it's all sort of interlinked into the other. But yeah, hopefully you found this video useful. I know it's a bit of a long one, but it's one of those bloggy pieces that, if you're really interested, you'll watch it. If you're not interested, you won't even be hearing my voice right now, because you would have already switched off, which is fine too. So hopefully if you are this far, you did find this video useful. But I just wanted to share what my investment criteria was, and what I'd encourage you guys to sort of look for and start thinking about your own investment criteria, so it will help you find good stocks yourself. Other than that, hope you found this video useful. Please like, please comment, please subscribe, and I will catch you next time with another investment video. Take care, guys.